Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm Tom Shellcross. With me, as always, is Mark Ainley. Mark, how are we doing today?
Hey, what's up? I'm excited to be here. What an awesome episode we have coming up here. But first, kind of share, you and me were texting this weekend, and you brought up kind of the strategy of what you've been doing after you put an offer, or after an offer that you put in doesn't get accepted. Kind of share with everyone what you do, how you're handling that.
Yeah, so we've taken down a couple of properties where we were, the market's crazy, where we were second or third place in the offer and just staying persistent with them. But a good example is we actually just closed on a flip that we were selling. The buyer originally called us after it was already under contract with someone else. We said, hey, it's under contract. They said, we still want to see it. In case anything falls through, we are here. We are your people. We said, all right, cool. We'll show it to you. And sure enough, the original folks who had it under contract started getting cold feet, started asking for a bunch of stuff in today's seller's market. And we said, okay, we're not going to go down this road with you. We're not going to go back to market. We're going to go to the people who reached out to us and were persistent, to this buyer. And sure enough, they bought that property from us today. But we've done that as well on the purchasing side. So I guess the point is, if you're offered on a property and it's not accepted, don't forget about it. That's what everyone does. Go after it. Find out why you didn't win it. Think about it right now. The market's tight. Buyers are getting more and more aggressive. Too many people are just trying to get things under contract and figure it out later. Right? Then they start second guessing themselves because they made the quick decision. There's plenty of times to just throw your name in the hat there of, hey, you don't need to go over the top. You don't need to raise your price. Just if anything happens, we're here, we're consistent, and we'll be ready to close. Right? You do all this work to get to the finish line. Like, don't let that last one slip away, because if you do that 10, 20, however many times, you'll end up with more properties than if you didn't do it at all.
With both my real estate agent and my investor hat on, you never want to go back to market. That's such like a depressing, reactivate motion that you have to do. To be able to just go to number two, or even calling up if you're their backup plan, to even start talking to them even before the deal is officially canceled. It keeps the ball rolling and keeps things moving. So stay aggressive on that. Like Tom said, it's awesome.
Yeah, you can't assume that they're just going to come back to you either, right? You have to make it known that you are there and just be politely persistent on it. So that's my little rant. So I'll turn it over to you. What do we got for our housing provider tip of the week?
All right. So this is something that's been around for a couple of years. So the Just Housing Amendment, it's a Cook County amendment that was passed a couple of years ago, where you have to screen your tenants a certain way. You have to, this applies to anybody in Cook County. So this is Cook County, Chicago, and Cook County suburbs. So if you're underwriting applicants in Cook County, you need to be doing a certain process for this. And we'll put the links in the show notes, and I have a whole bunch of instructions on that we'll link to as well too. But make sure you're following this law. You are not allowed to be pulling credit and background at the same time. You have to first see if a tenant is approved based on, call it their employment, their income, their rental history. And then if they check out, then you could pull the credit. So this is a big thing that I heard a property manager get in trouble for. I heard another investor get a claim filed against them for as well too. So they're starting, even though this came out in 2019, we haven't heard much about it, but I think they're starting to come out and starting to enforce it, or at least call people out that are not following it. So anyone that's in Cook County, make sure that you're following the Just Housing Amendment. It's important because there's hefty fines, like $500 a day. There's a certain way that you have to market on the listing side. There's a certain disclosure you have to have in your application, and there's a certain way you have to decline an applicant if it has to do with their background.
Awesome. And we'll link to that in the show notes. Well, cool. Let's dive in. We got a big guest today, Mark.
Yes. Biggest. Yeah.
We got a heavy hitter. So our guest today, former police officer. You probably know him best as the co-host of the Bigger Pockets podcast, author of the best-selling books, Long Distance Real Estate Investing, Buy, Rehab, Rent, Refinance, Repeat, and Sold, Every Real Estate Agent's Guide to Building a Profitable Business. He's nationally recognized as an authority figure on real estate. He's been featured on CNN, Forbes, HGTV, and numerous podcasts. He also runs a successful mastermind, the David Greene Mastermind, which we'll dive into. As a real estate agent and loan broker, he runs the David Greene team, a top producing company within Keller Williams, and is an active real estate investor, owns single family properties around the country, shares in apartment complexes, notes, and in note funds. So without further ado, David Greene, welcome to the show. David, we rattled off the 3 different books. Which one is your favorite child? Which one is most near and dear to your heart? And we will start there.
So that's a good question. Long distance investing was my first child. BRRRR is my most successful one, but I think Sold is probably my favorite.
All right, man, that was a good like answer of like how to not neglect any of your children. Nice
Yeah,
one.
yeah, that was very close. Yep.
So it sounds like you've done this before, David.
That's the problem with becoming a politician is the bigger that your word becomes, the less effort people put into trying to figure out what you meant by what you said. So if somebody says like, are you for or against vaccines? And you say, I think they're good. That immediately becomes, I think everyone should be forced to get a vaccine and lined up in a row and like march through like, no, I didn't say that at all. Right. So you end up having to spend so much more effort clarifying simple things because people will run with it. So I like Sold the Most mostly because it's about how to help real estate agents. And there's very little information out there if you're a real estate agent who's trying to get ahead. Like there's one book called The Millionaire Real Estate Agent that has any value that I've ever read at all. So to me, that's where the front line was weakest. And so I liked running to put my reinforcements there. There's a ton of investing information, BRRRR, long distance investing. I think they're good books, but they're not as crucial to the industry because lots of people have written books about that stuff.
Yep. Makes complete sense. So let's dive into some of those concepts in Sold. So, almost all of our listeners are on BP. It's great. They also find, a lot of value in our podcast here for the local insights. The books you just mentioned are great. Anything from Gary Keller. But one of the things that Mark and I harp about is we hate hearing when someone says, oh, after I read this book or after I go to this conference, you've referenced in the book, a lack of knowledge is not what it takes to get ahead. The solution is psychological, not tactical. Dive in there, man. We've heard you rant about this before. The floor is yours. Let's talk a little about this.
So I'll tell you the motivation for why this is really important to me. A is just you want to see people get ahead. And the way that the human brain works, just from my experience and the experience documented by other people I respect, I don't have like studies to prove this, but you learn through, I don't know, science hasn't created a fancy definition, I know, but you just learn from doing. If you want to go learn jujitsu, when you get in there and roll with somebody and whatever you didn't work, there's a different kind of acceptance of knowledge that, okay, I don't know as much as I thought, my way doesn't work. When you tried it your best and you failed at it, you could have someone make an argument to you on a PowerPoint and show you all the ways that maybe jujitsu has been shown to be a better thing for this job you're trying to accomplish. It's not the same in your head. I don't know, like the emotions don't get attached or whatever. And so when people are selling knowledge, even though it's been shown in so many ways, knowledge doesn't create lasting change or impact. It's often because they're taking advantage of the person buying it. So there's all these like gurus out there charging $100,000 to teach you how to flip a house, or courses that are out there that want a lot of money. And what they're offering is knowledge. Like literally, sometimes they just give you a big binder with a bunch of words in it and say, here you go, you got the knowledge. But in order to get you to do that, they have to sell you on the fact that what you're missing is knowledge. And that's not true. What you're missing is not knowledge. Knowledge is everywhere. It's on podcasts, it's on YouTube, it's in books. You could buy a book for $20 that has all the knowledge you need. It's like you could read a book about jujitsu. It's not going to help you in a fight. It just doesn't matter until that becomes like what I would say kinetic knowledge. Your body understands there's muscle memory associated with what you're trying to do. You need that in business. You need that in investing. What people need to do if they want to learn something is throw themselves into that world. Okay. Like the old method of apprenticeship that we don't have anymore is one of the saddest things. Like that's part of the downside that came out of all these like labor regulations is now companies can't offer apprenticeships, which is where people learn the most. You jump into this thing, you learn it, you don't make any money at it in the beginning, but you get exposed to it until you build up this skill set that actually becomes something that can make you money. So people listening to podcasts like this is not bad. It is not wrong to listen to podcasts. It's not like knowledge has no inherent value. The problem is it is sold to you as if that's it. That's the only ingredient that you need to be able to build this cake. Here's a bunch of sugar. Okay. You also need the egg and the flour and whatever other stuff people put in. I don't bake. I don't know hardly anything about it, but I know you don't have a cake unless you have everything together. And then you need the skills to put them in the right way and to put it in the oven for the right amount of time. Like just having the ingredients alone doesn't make a cake either. There's a skill of application that goes into it that is also present in things like real estate investing. So take this knowledge you're getting and then say, what is a safe way for me to go apply this? You don't want to go jump into a street fight, but can I go into an academy and have a nice safe role with another person and learn a little bit more, get some more knowledge, then go into application? You kind of have to have both. So I rant all the time because the expectation people have is if you tell me what to do, that is the same as making me good at doing it. And it could not be further from the truth. Okay. Like Bruce Lee can tell me this is what you do to throw a kick. That does not mean that my body can go out there and make that kick the way that Bruce Lee can do it, who's done it 10,000 times. Yeah, no,
that's it's so true. I tell people often, I started my real estate journey back in 2002, 2003. And you didn't have, I always tell people, you guys are lucky. You have podcasts, you have meetups, you have audiobooks and all that. But probably the reality of my success was I just had to figure it out. I just had to jump in and do all that stuff. Mm-hmm. Now the dichotomy is I probably made a lot more mistakes without having both the experience and the podcast to back it up. But that's ultimately me jumping in and figuring out the jujitsu moves while I was in the fight was what got me to where I'm at today.
Yeah, and there's also a I don't know the word to use to describe this phenomena that you experience, but there's a difference for how serious you take what you're being taught when you're just sitting there and people are telling you, hey, here's the way you execute the technique, versus I had someone choke me out and I did not like how that felt and I didn't listen close enough to what to do. Now you got my attention and this information is going to stick. Like when you're in the game and you're going to that seller to try to negotiate this off-market deal, all that information you learned about negotiating becomes very important. But when you just read the book, you're like, cool. I know it, right? It doesn't mean that you actually can apply it. You didn't role play. You didn't practice. You didn't start with something smaller and learn how to negotiate there and work up to something bigger. So sometimes walking in and getting your butt kicked by taking action creates this like soil that's fertile for the knowledge that you're now planting in it. Whereas if you're just always in the stage of nothing but knowledge, those seeds are falling on rocky ground. They never really take root.
Yeah, it's good.
That's great stuff. So David, circling back to the book, you do a nice job laying out mistakes that investors make when choosing an agent. And most of our people listening here are investors. So if you're in their shoes, what are some questions as an investor I should be asking agents when I'm trying to find that right partnership?
All right. So the first thing I would say has to do with the mindset that investors should have when working with an agent, and the mindset an agent should have. I think real estate sales and to a degree real estate investing are incredibly difficult to be good at, not because they are inherently hard things to master. They are not rocket science. They are something that most people have no background or context to compare this to. There is no job like a real estate salesperson that you've had in your life before this. That makes it difficult to succeed. Okay, so what happens is people default to the mindset they had at their W-2 job. And that is toxic in a lot of ways. The way that we grow up working, or the way I grew up working, which I think is how most people are, is very egocentric. It's all about the employee. And employees complain all the time about their jobs. They just don't realize many employees bring very little value to the company at all, but they still get paid. Okay. You basically like take my job I had at Togo's, one of my first jobs. I wait for someone to walk in the door. Somebody else did all the marketing, the advertising. They created the product. They built the recognition. They put the corporate structure in place. They hired people. Like they did a ton of work just to create this world that somebody would walk in the door and say, I want a number 4. I didn't even have to walk the person through what sandwich they might want or give them options. I literally just stood there and they said, I'll take a 4. And I had to say, do you want a large or a small? Okay. And then there's a list of all the stuff on the sandwich and they just have to tell me if they don't want it. Like that job was created to make my job as the employee as easy as stinking possible to not fail at. But I would be in this mindset of, man, I do everything around here. I got to go get my own tomatoes out of the fridge. This is ridiculous. Why isn't anyone bringing them to me? I'm busy. Let alone the fact that I didn't have to order the tomatoes, create a place to put them, make sure there was a fridge working, right? Like you get this toxic attitude that you are working so hard and you are doing so much and you're really not. Then you get into a world of entrepreneurialism, investing in real estate, being a real estate agent, and all of that's gone. It's completely taken away and you are ill prepared to step into the situation where you are responsible for all of it. So the first thing I have to tell agents is understand you have the wrong mindset if you ever had a job. People come to my office and they're at the office all day and they leave and they say, I worked an 8-hour day. I said, no, you spent 8 hours sitting in a chair looking at a computer. You didn't do work. You didn't do one thing that is likely to lead to you getting another client. And you're going to continue doing that for the rest of your career until you get out of the belief that being in the office equals work. That is not the case. That works at a W-2 job where somebody else is responsible for the results and you are just responsible for this tiny little piece you play. So I tell agents, you don't work for anyone. And I tell investors that agent doesn't work for you. This is a relationship. It is either mutually beneficial or it is terrible for both parties. We only win if we end up actually getting a property under contract and closing on it. So if you just make that little switch, you are not hiring an agent to do a job for you. You are looking for a partner, just like dating. Okay. And you walk into it saying, here's what my needs are, like you would tell someone you were dating. This is what I am looking for. This is what success looks like for me. What is that the same with you? And then that person says, well, yes, it is. Well, here's my expectations. I need someone that can do these things for me, right? I need someone who can iron my clothes. I'm a police officer. I don't have time to do it. Is that something you're willing to do? That conversation never happens between agents and investors, first off. So investors end up hiring an agent that wants to help them and tries to help them and doesn't know how to help them. They're working really hard, doing everything they can, not understanding that that's not what the investor needs. So that would be the first piece I would say is, get out of this belief that you found an agent and it's going to work. You don't know if that person can even help you. The second piece that I would say is you need to look for an agent who thinks like you think. They need to know when you say, I want a good deal, that never gets defined, what that means. Once you go into escrow, like here's a common thing. When you're just a regular buyer looking for a house, and you're looking at the same house as everyone else is looking at, the agent is mostly providing an emotional support system. That's what they're doing. They are making you feel comfortable with this purchase. They're going to hold your hand. That's the value that they bring. The second you transfer into, I want an investor agent, you also have to let go of they're here to give me emotional support. That's not really their job anymore. Okay. Their job is to give you a skill set very few other people have. Finding opportunity, casting a vision for you, helping you get that deal, helping you run numbers, maybe helping provide you with some of the resources. But you don't also get all the emotional support you got from an agent that had to do nothing but show you homes and let you pick the one you like. That comes up a lot where people complain about the service they got. They want their agent to call the city and ask about like zoning regulations or attend the city council and say, hey, you're representing me on this deal. I want you to go convince them to zone it for R2 so I can buy it or whatever. That's not your agent's job. And the good agents are actually going to tell you, no, that's not what I do. I do not have time to go do those things for you. If you want to be an investor, that is your responsibility. That's what the investor does. I help you with this part. And that conversation doesn't happen. That's another thing that causes a lot of hurt feelings between the two sides.
There's so many realtors out there, so many licensed real estate agents, I guess. And we all know there's just a very small percentage that end up being successful based on volume or gross numbers. But then when you get into the investment minded brokers, that's the term we use on here all the time, investment minded brokers. They're even fewer and far between. And I think you hit it on the head with, when you are a successful realtor, it's because you're laying out what you're going to do and what you're not going to do. And you're setting up those expectations. And you might just not work with people because their expectation of you going to the meeting is ridiculous. Yes. And you just choose to, you're not going to grasp for any type of client. You know exactly, as a strong real estate agent, you became who is an ideal client for you and who you could benefit the most so you could serve the most people.
Yeah, I look at it like this might not be the best example, but when I was a police officer, we would see a lot of people that got public defenders that would be issued to them. Okay. And I'm trying to be sensitive of anyone who's ever had family members or themselves been in that position. But usually when you get a public defender, you're not in the best position possible. And I would say the likelihood of you being guilty is probably much higher. Public defenders are really there and they just kind of make the experience less painful for their client. Okay. They're in a bad position. They're trying to soften the blow of what's coming their way. They're not going to win a lot of cases. Like their win-loss record's incredibly low. That would be your agent who's there to help you buy a regular house where you want a cute kitchen and a nice yard and you're just scared about this commitment you're making. Then you have your like top-notch, incredibly skilled lawyers that are pit bulls that know the law better than other people do. And they're going to go in there to actually get you off the hook. Okay. They're probably not going to be up till 11:30 at night talking you down when you're really nervous. That's not what like, if you want their skill set, you're giving up something to get it. And that makes sense when we're in that perspective. I wish more people would understand that with real estate. There's not a lot of agents that are good. And of those that are good, there's very few, like you said, that are investment minded. It is difficult to build the knowledge base to even help an investor in the first place. And their brokers are not providing them with that. That does not make money for the brokerage. So if you find an agent that's actually good at that, they had to build that skill set up on their own. So I guess what I'm getting at here is if the person who wants to work with an investment-minded agent, they need to lower their expectations for what they're going to be getting and understand that you're getting this skill set. You're not necessarily getting the full package of emotional support. And I think that now puts responsibility on the client to come up with what their criteria are, what questions they have ahead of time. You can't wait until like this person's put a lot of work in and then you're like, man, do I even want to do this? And the people who do that well, man, they're much more successful. They find the good brokers and those brokers work with them. So I think just understanding this whole world of real estate, there is so much lack of clarity on what an agent even does. And the bar for entry is so low. So it's so easy to get your real estate license. And most agents sell like 4 houses a year. Is there anything that anyone's good at that they do 4 times a year? You know, like they're not going to be very good. So I really caution investors before you get into this, like commit wholeheartedly. Look at the team you have around you. Is your point guard somebody that plays basketball 4 times a year? You're not going to be very good winning championships if that's what you're doing. You're going to have to put a little bit more time into getting the right pieces around you before you jump into this.
I imagine you have, for your team that you run, when you get the right broker or the right investor-minded broker, you're also tapping into their network as well too. I think some of the best brokers, they're not waiting for something to come on the MLS. They know stuff that's coming on the MLS before it never makes the MLS. So they know they have an off-market network, or they have different. You're getting so much more than your traditional broker as well.
Yeah, I would say, just for clarity's sake, though, like this is a problem that we run into. People don't see what goes on behind the scenes. Let's say that I've got an off-market deal, and that client has come to me to say, sell this house. I have a fiduciary duty to do what's in their best interest, which in most cases means get them the most money. In some cases, it doesn't. They just want it sold fast, or they want it sold easy. But oftentimes they're saying, David, you're the guy I go to get top dollar. So knowing of an agent with off-market deals does not equal automatically best deal possible. Okay. And a lot of people make that mistake. They jump from broker to broker and they say, well, do you have off-market deals? As if off-market equals better. Many times in my world, which is admittedly high stakes, like the San Francisco Bay Area is incredibly competitive. Just to get a house at all is hard. You're not even trying to get a deal in a lot of cases. The deal is just getting the house, because appreciation is so much it's going to be worth more. We sell houses off market to each other, not because the price is better, but the people are paying extra for the certainty. Like, I know for this price, I can get the house. I'm not one of 15 offers and I don't know if I'm going to get it or not. So understand there's a balance there too. When you buy off market, sometimes you may even pay more. What you're paying for is the knowledge I'm going to get it. I don't have to worry about if I'm going to get it. And I only bring this up because in the last 10 years, like how real estate transactions go down has changed massively. Like when I started, it was every 4 houses was for sale. They were all REO. It would be listed at 200. I would offer at 130, and I would just blast offers out, and I'd see who even countered me. And that was where I started with my time. Then that moved slowly into, if you write below asking price, you're not even in the game. Then that went into, you got to accept you're going to pay over asking price. Then that went into, it's how much over asking price can you go? And now it's at almost a point where even if you go, like literally sometimes we just wrote an offer on a house in Fremont that was listed at 900,000. My client wrote it at 1.6, all cash. And we were not even the number 2. It ended up selling for 1.8. Like it sold for twice as much money as it was listed for. That's a situation where you don't even know how much over asking price you have to pay. Okay. So like I tell some of my clients now, just don't try to buy in Fremont. That's just not a good city to look at. So real estate works that way. It's like the NFL. Like look at when we were young, how many points were teams scoring? Like you won in the NFL back then by wearing down defenses, and everything happened in the fourth quarter. You just ran the ball and you tried to injure the other team and wear them down and get them tired. And then in the fourth quarter, tired players would miss tackles and big plays would open up. They've changed the way that wide receivers can be touched and quarterbacks can be touched so much that you can score massive points very quickly. Football is completely different. And if you're trying to play it the way that it worked 10 years ago, and you're trying to draft like bell cow running backs, or having 2 running backs, or offensive linemen that can open up holes for running backs to run through, but don't protect the quarterback, you're going to lose. So I guess this is a long-winded way to start a podcast. I don't think I've ever done this before. That just wants to highlight for both investors and agents, you got to understand the game is changing. There's massive inflation right now. The government, every time we have a problem, just spits out money. And I don't see that changing. If you're the politician that steps in and says, I'm going to put an end to this. We're not printing dollars. We're not spending our way out of problems. No one's voting for you. On both sides, right? They're going to keep lowering interest rates because it makes the economy look better, which makes it easier for them to get elected. And no one right now really cares about the future consequences for that. And real estate is going to benefit massively from inflation. Then you throw onto that, regulation's not going down, it's going up. It's getting harder and harder to start a business, build a business, all of that. That means less companies are going to build houses. When they do build houses, they're going to build expensive ones because the profit margin makes sense. They're not building starter homes. There's no money in it for them. So now you have more inflation and less starter homes available. The prices of those things aren't going down, right? The rules of this game are changing. So that's why it's so important that if you want to build wealth through real estate right now, you have to understand. It's like saying, I want to run a really good NFL team. I want to win games. You got to know how the rule book is being created to know like what players to draft and what plays to run.
David, that's great. So along those lines, then, what I'm picking up between the lines is, are you bullish on being I'll say responsibly leveraged, but highly leveraged, just for that reason, right? If my rate's at 3-4%, whatever that is, you're banking on inflation being much higher and winning just on that offset, on that arbitrage.
So my personality always gears towards play the safe game. Okay. I don't like leverage for that specific reason. And that's kind of how I really built my portfolio in the beginning, was very safe movements, very safe purchases, more money down, don't scale too fast, get it down. And the way the rules have changed, it feels a lot like if I've been saying, look, don't throw the ball, you can have interceptions. Okay. Play it safe, run the ball. We're just getting blown out by teams at this point that have learned how to throw the ball, and we can't keep up. And it's now irresponsible, I think, to tell people like, don't leverage. Now, over leverage is first off, I'll say it's so much easier to tell people be careful, don't make a bad move, than it is to say go be aggressive. And that's why everyone says it. Like Dave Ramsey will never, ever, ever catch heat for saying don't take debt. Okay. Like it's always, you can always say, don't throw the ball. There will be an interception and it will sound wise, until you look at what the other team's doing and how far you've fallen behind not throwing interceptions. You're not actually scoring points. So I am leveraging hard right now. I am borrowing as much money as I can safely do. And I am wanting it to be at very low interest rates at income producing real estate. I'm not doing this with Ferraris and boats and stupid stuff like that. The way I'm protecting myself is not by borrowing less money. It's by putting more in reserves and investing in areas that are going to produce more income in the future than what I borrowed. Okay. So I'm not finding safety by not getting in the game. I'm finding safety by the way I play the game, if that makes sense. It's maybe one extra layer of complication that people don't want to deal with. So I'm buying as much real estate as I can. And then I'm saying, look, this is creating a little bit more risk. I have higher debt responsibilities now. I got to buy in safer areas. I got to keep my personal income low. I can't just like spend all my time on the beach having fun. I need to still continue building companies to cover me in case we do have a downfall. And I need to set a lot of money aside in reserves. That's really where my safety comes from. So to me, that's the perfect mix, is that you continue aggressively buying, but you also aggressively save.
Do you have a rule of thumb as far as what is a good amount of debt per property?
Yeah, it's hard to do that because it's a good question to ask, but it's hard to answer. And that's why people are going to be disappointed. Like many people will say, save up 6 months of income. Okay. Well, that just coincidentally coincides with how much lenders want you to have in reserves to get another loan. So I think that's where that number came from. But my number will be different than someone who's listening to this that's a school teacher. Like they make a certain amount of money, they can save money at a certain rate. There's very little flexibility with how much money they can earn next month compared to this month. They need a higher number than me. Depending on what effort I put into my businesses, I could make 6 figures more per month than the last month, right? So I think I can play it fast and loose safely because I have these options available to me. It's just like a team that if they know they can put points on the board, they can blitz more often, right? They can maybe run the fake field goal because they know that, hey, if we blow this, we can get points on the next term. As compared to a team that can't put points on the board nearly as much, they got to really be careful and conservative with their offense and just get a field goal because they're relying on their defense. Everyone listening has to look at their own financial situation, right? If you are in a place where it's hard to save money, or it's a lot of work to save money, you need more in reserves than the person like me that's single, doesn't have a family. I could easily sell off assets if worst case scenario ever happened, or I could go generate money in a lot of different ways.
That's an awesome answer.
I know it's not this number. That's what everybody likes to hear.
I mean, but you put it in a way that it can really be clear to everybody. So that was an awesome reply.
Too many times we try to simplify things, right? We try to say, oh, this is the number, right? This is exactly what you need in reserves. Or the other, and when you're analyzing deals, it's this much in CapEx, this percent in maintenance.
Yes.
The world doesn't work like that, man. Like,
so right.
It doesn't work that way.
You're so right. There's a comfort that we try to take from, like, especially human beings that love spreadsheets. There's something that comes from, like, you're taking this like a football game that you don't know how it's going to play out, and you don't like that. So you try to like average out data to say, well, we're going to have 2 fumbles per game. So blah, blah, blah. Like, you might have a game with 4 fumbles or a game with none. And the game with 4 fumbles might be fine if the other team's not scoring that game. Right? Like, the world doesn't care how we want it to work. It doesn't care what your CapEx budget is, right? Some of the properties that I bought in Arizona, I may never put a roof on that property for 80 years of owning it. It's maybe had one roof the entire time. Nothing happens to that roof. But you buy something on the East Coast and you might need, your CapEx is going to be way higher. But that usually means the rent to price ratio will be stronger on the East Coast than it is in Arizona. So the problem people make is they'll start looking at, okay, I get the best cash flow in the Midwest, so that's where I'm going to invest. And they don't understand the reason you're getting great cash flow is because your appreciation is horrible in those areas. And they won't value appreciation until there's a big CapEx event. I need to put a new boiler in this property. I need to put a new roof on it. The air conditioner went out, and I've owned it for 5 years and it's increased in value by $2,000. And all that cash flow is gone putting one heating unit inside of it, versus the properties in California that appreciate so fast that you could literally just refinance it to pay for all the CapEx you could ever need in one case. So I know I'm kind of ranting there also, but it's the problem when you're not looking at it holistically. When you focus in on one little piece and ignore all the rest of them, you get into these situations where you're asking the wrong questions and you're making the wrong moves.
Couldn't agree more, right? Like, cash flow is the nice, safe thing to talk about all the time, and it's important and we all need it. But I feel like it's been highly over-indexed, right? Like, you don't hear Sam Zell, you don't hear the big hitters here talking about, how much cash flow they have. They're talking about their net worth and how much they have on the asset side versus the liability side.
Yeah, I can comment on that too. And here's why I think that's the case. And this is going to be shocking for a lot of people that have been hearing cash flow, cash flow, cash flow. That was good doctrine when it first came out, which was right after the last crash. And the reason is that people were buying properties that did not cash flow and were literally too ignorant to understand it should. So the reason they lost their property was because it didn't cash flow. So the knee-jerk response was, tell everyone to cash flow and we won't have the problem of you losing a house when it goes like down in value like musical chairs. That it also became a way to sell people products, because if I can sell you on cash flow, I can like get you to quit your job. It becomes the magic pill that will solve everything you hate in life. You're sick of being in a commute. You're sick of working for that boss that keeps wanting you to actually do work when you're at work. You're sick of being late and having to be held accountable for it. Well, fire your boss and buy real estate, and cash flow can fix everything. So now there's this emotional component that makes cash flow really important. But like you said, the heavy hitters, the people that know what they're doing, they almost don't talk about it because cash flow is a defensive metric. It keeps you alive. It does not win you games. That's the problem with it. Cash flow is designed to stop me from losing a property. It's not designed to build me wealth. And the experienced people that are investors sort of understand that. They see cash flow as one of maybe 5 ways that real estate makes money. And in some cases is the smallest component when you look at everything all together. So I'm really glad you guys are bringing that up, because it sounds heretical just to say cash flow isn't the only reason that you invest. But when people understand why they're being sold that dream, I think it'll open a lot of eyes.
Yeah, absolutely. So great stuff there, David. So along the same lines, let's touch on BRRRR here. So almost all of our listeners understand the concept. We don't have to go through that. We understand it's a great way to create equity, a great way to recycle your funds. Besides the inflation we just talked about, I want you to hit on some of the points, because how would you, I guess, put it this way? How would you respond to the naysayers out there saying, well, BRRRR is risky, BRRRR is high leverage? And I'm looking at it like, well, no, I'm 25% down, just like someone who bought this property from the get-go, except I have, 100K in equity or whatever my spread is. So rant on here. Let's hear this, because I've heard you guys touch on it a little bit, but I want the explicit answer.
It's almost unfair. I'm like undefeated when it comes to somebody criticizing BRRRR. And it's not that I'm so great. It's that they're just, usually the objections are coming from a place of ignorance. I don't have to be that good to defend this. They just don't know what they're saying. So the common objection is it's risky because I'm over leveraged. All right. And that's coming from the fact that we are advising you to refinance as much of the property as you can in most cases. And so immediately what the benefit of BRRRR is you can recover all of your capital or more than your capital by doing this method. So because we're preaching that as a benefit, the naysayers come in and say, oh, that's 100% leverage. It's not. It's 100% of what you put in. It's not 100% of what the asset is worth. It is the same as putting 25% down if you get 100% of your capital out. Okay. You still have 25% equity in the property. That's the first obvious defense against the people who say it, that show that they're not really aware. The next would be, I'm not even sure that putting 25% down on a property is safer than not doing that. Okay. There's this belief people have that if I'm going to buy $1 million property and I have $250,000 in equity, that I have a cushion that it can drop to 250 and I'm still safe. That's what they're thinking. That only even matters if your exit or your plan in the case that it goes bad is to sell. And if your only escape from this deal was, I'm going to buy a property and if it loses value, I'm just going to sell it, you walked into it doing it the wrong way, right? Like nobody starts a football game and says, hey, if they kick a field goal and take a 3-0 lead, we're quitting. Let's get out of this thing right off the bat. Okay. It should be cash flowing and you should have enough in reserves that it's fine if it loses value. It almost doesn't matter to you if it loses value. Okay. Like I don't care what my properties are worth at any given time, unless I'm looking to sell it. That is the only reason I would even care what my property is worth. Okay. And I'm of the opinion that if I borrow more, pull more money out of it, put less money down, I take the money that used to be equity in the property that I cannot control because the market determines what that is, and I put that equity in a bank account that I can control. And if my property loses value or I lose my tenants or something happens that makes me lose money in this deal, I've got this huge, big safety cushion of money in the bank that I kept as reserves that will bail me out. That is so much safer than leaving a cushion in a property that just allows me to sell it at some point. And that would be the second fallacy I would say, is the belief that equity in your property is keeping you safe. That is a total false sense of security. You don't control equity at all. In 2006, if you bought a house for $500,000 and put 20% down and you went in with $100,000 of equity, what was that worth in 2010 when that property was worth $200,000? That whole $100,000 was worth nothing to you. You couldn't control it. Now, if you kept that $100,000 in the bank, when your property lost its value, if you had to pay an extra $500 out of pocket, how long can you sustain with $100,000 if you're paying $500 a month? Okay. More than a lifetime. And so you just wait it out and then all the values would come back up and you're safe. So I'm of the opinion that if you actually want to be safe, put more in reserves. Don't put it into the property. And then the third piece, what was the third piece that I was even getting? When I rant, sometimes I lose track of where I was as far as something. Oh, it's that putting more money in a deal is probably riskier. If you do worst case scenario, you do everything wrong and somehow you lose the property. Did you want to lose 3.5% of your capital or do you want to lose 25% of your capital, right? You can only lose what you even put into the pot. So I don't think putting more money down makes sense for most people in most situations. If interest rates are 15% and putting more money down is decreasing your payment by a significant amount, I'm with you. For many people, that's the case. If you don't really know what you're doing and you're just shooting blind, I suppose there's an argument that putting more money down can decrease your risk by a little bit. But I would say if that's your defense is how much money I can put down, you shouldn't be investing. Stop right there and learn more about what you're doing before you get committed.
Yeah, if you have all that money into it. So if you don't have the money into a deal, that means you bought it right as well too, because you were able to get it appraised out and pull the money out. So I'd much rather have the money in my bank and control that versus this paper equity all day long. And like you said, worst case scenario, I'd rather walk away with the 20% in my bank account than the 20% in that I lost in the equity if I had to. Worst case scenario.
Yeah.
Yeah, couldn't agree more. I mean, I think that the risk in BRRRR is, can you execute the plan? It's not the end of it. It's can you actually go through and execute and end up with something worth 400 that you spend 300 to do.
It's harder to do. It makes you find better deals because it's more complicated to pull off.
Yes. So staying on the BRRRR topic then. So Chicago is a very diverse market. We have multi-million-dollar condos and we have things trading at $10,000 a door. Right. Like we are all over the board with our neighborhoods. Do you feel there is a certain price point where BRRRR might work better compared to others? Like, is it work better in a lower neighborhood, higher, et cetera?
Well, that's a great question. And the way I answer that is I tell people, let's start at the end and work backwards. What is the end result of a BRRRR property? What do you have when you're done?
A rehab project with a tenant in there and hopefully an ARV that is, whatever, 75% of the cost, meaning your purchase, your rehab, et cetera, or whatever numbers you want to use.
Mark, what were you going to say?
Rent's covering your total cost.
That's true too. So what you described, if you did it well, you'll have your equity out of the deal. You'll have a rehab property. But the simplistic answer is you have a rental property. That's what BRRRR is it's a way to get a rental property. And like you said, Mark, you should have your rents covering it if you want to have a rental property owned the right way. Okay. So right off the bat, you're trying to get a rental. The BRRRR method is just a way of doing it that forces value add and gets your capital out of the deal. It's just a better way of doing the same thing of what we did before, which is just buying a rental. If you're in a price point where your price to rent ratios aren't making sense to own a rental property, by nature, BRRRR is not going to work very good. There's a spectrum, like we call the 1% rule. If a property will rent for 1% of what its value is every month, it's probably going to cash flow. That has become much more lax. The higher of a priced property you get into, that becomes less important. And as interest rates go down, that becomes less important too. I think 1% rule is sort of developed at like 8, 9, 10%. When rates are at 3, 4%, it doesn't need to be quite at 1%. But the principle remains the same, that there is a point of where the rent you get and the price you pay for the house, there's a relationship between them. The more expensive that the house goes, the harder it is for the rents to keep up with it. You guys have probably seen that in many cases, right? And that's very simple to explain too, because at a certain point, if you're making $10,000 a month, you're not going to go rent $1 million house. You're going to go buy one. Like you don't need to rent someone else's property. So there's the tenant pool who's renting homes are always going to be at a certain economic situation, because if they weren't there, they would buy a home. That they're renters, and that's where renters are living. So you've got the correlation between price and rent that you have to think about. If prices get too high, you're not going to be able to rent it out to cover your nut. So right off the bat, that eliminates the high-end real estate. You're going to be dealing with starter homes because that's where rentals are. And so when you're talking about like in a city, where do you want to be? You have to figure out at what price point you can't make the rent cover the mortgage. Right. And then just cut off everything above it. And what you're left with is the houses you could be evaluating for BRRRR. And that makes it a lot easier. Now you're just saying everything at this price point or below, I can look at what are the trashed houses that are in this price point, because those are the ones that are going to give me the best opportunity to execute the plan.
Yeah, that's so good. I mean, people ask why we flip on the Northwest side. And the simple answer is, well, we know this area, we can get deals in this area, and you can't make it work. Yeah. Right. You can't, a $400,000 house here rents out at $2,000. You'll never make those numbers work. So you flip it, you take the money and you find something else.
That's exactly right. And I think that's the mature way to look at real estate investing, is you're not trying to force every square peg into a round hole. You take the cards that you're given, you look at them, and you make the decision in the poker game based on the cards you got. And sometimes that means playing the hand this way. Sometimes it means playing the hand that way. Sometimes it means not playing the hand. In fact, most people, when you play poker, should fold most of their hands. Most investors should not buy the majority of deals that cross their path. But when you do find a deal, the question should be, what is the highest and best use of this property? And sometimes that's a flip. Sometimes it's a BRRRR. I'll tell you another one that nobody talks about, but they should be, is house hacking is just like the Stephen Curry of real estate. It's a cheat code. It is so stupid easy to make a smart, safe investment because of the way financing works. I hear people say like, well, I want to BRRRR in this market. I'm like, you don't need to. You could just get a 3.5% down and you accomplish the same thing as a BRRRR without all of the missed ARV and rehab potential to go wrong. Like all the risk that goes in there, you can accomplish it just by doing this. And you can do that every year. You get one freebie a year as a house hack that everyone should be buying before they even consider the BRRRR or the flip.
Love it. Yeah, and I mean, Chicago's got headwinds here. Like we know we're tenant friendly. We're tenant friendly. We have politicians. We have this, that, and the other. But we also have a housing stock of a ton of 2, 3, 4 units, and it's just so easy to house hack. It's so house hacking friendly. So
yeah, so if that's what the defense has given you, they're just like, hey, we're like running a prevent defense every single time. Just run the ball up the middle, and you can pick up 15 yards. Keep doing that until the rules change, right? Just house hack in Chicago, find the best neighborhoods, buy those 2, 3, and 4 units. Don't overcomplicate it. Make massive progress there until they're gone. And then we can have the discussion about, okay, what plays do we want to run or how do we want to adjust our strategy?
That's great. So David, you've been a successful investor, an agent, a coach. You're doing lending. Obviously, you have BP, so many good things. And I want to talk about the mastermind. But before getting there, you started as an investor. How did you pivot to these other roles, right? We talked about Gary Keller already, the one thing and focus. Yeah. When did you make that shift and how did you do it without losing momentum or velocity in the other areas?
I made the shift when a group of guys that I knew from a group I'm in called GoBundance basically saw that I was working 100 hours a week as a cop, saw that I was afraid to stop doing that because that was my main source of income. And that income was tied to my investing. I had to make that much money to be able to invest. So it wasn't just quit being a cop and be an investor. The minute I did that, I wasn't going to be able to get financing to buy houses. I wasn't going to have the down payment to buy them. It would have made that way harder. And so they said, look, what else could you do to make income? And I said, well, I could probably be an agent. I represent a lot of people to other agents. And they said, yeah, you should do that. It was that simple. So I got my feet wet and really, that's probably a bad analogy. I got my teeth kicked in being an agent for a couple of years, trying to figure out how to make that work for my personality and my skill set and everything. And then what I realized was that I didn't just learn how to be an agent. I was sort of like training wheels to learn how to run a business. I think becoming a real estate agent it's not a job. It is a business. And most agents don't treat it like one, which is why they don't get good results. But it forces you to become a business person if you're going to do it well. And so I built a team and I was probably more successful because of the second answer to your question, which is synergy. When you look at skills you already have and you try to find a way to build those into your new projects, it becomes so much easier than starting something new. And this is just something entrepreneurs, investors miss. If you're flipping homes and you decide you want to keep rental properties instead of sell them, the switch from flipping to BRRRR is like, you're only changing the last 5% of the entire project. Okay. You're maybe using different materials when you flip. And instead of putting it on the MLS to sell it, you're going to a bank to refinance it or a lender. You're not rebuilding the wheel. You're just changing the very end of it. So for a 5% difference in effort, you're getting 100% new business opportunity. And I sort of ended up doing that with real estate. So I took my knowledge of how investment works and I applied it to becoming an agent. And I was able to help more people because I knew more about real estate. It made me stand out different than other agents. Then I took the systems that I created as an investor and the belief that everything should be passive. I need to refine this until it takes care of itself, which is a principle we love about owning rental property. And I applied it to being an agent. And I started delegating the work I needed to be done to different people until that became somewhat passive. I can now generate clients and pass them off to other people who can use the skills that I gave them and the method that I created to go close them. And then I said, well, I'm doing this as an agent. I could do this as a lender. And I started a mortgage company. And in our first 6 months of being in business, we hit top 25 in the state of California. And that's not just because like I'm some amazing businessman. There's just so much synergy with what I have. The real estate team is closing 30 to 50 deals a month. That all goes to the lending team. The understanding of how to take a job of being a loan officer and delegate it into 3 different pieces and have people working on the part that they're good at made sense to me because I had already done that with the real estate team. The skill set of understanding how a mortgage works is very similar to how a real estate transaction works. So it wasn't like I went and bought a pizza restaurant and had to figure out how to run that thing from the ground up. So it looks like I've got my irons in all these fires, but if you actually like zoom out and look at the whole thing, it's like one fireplace that has a couple different pits inside of the same big world. They're not that much different with the way they operate. And then I can move pieces in between them much easier, right? Like my hiring funnel for agents produces a lot of my loan officers, because you wouldn't be a good agent because you're not a Pop-Tart. I need you to have some flavor. You're a brand muffin. Well, you'd be great as a loan officer or a processor. I don't need you to have any personality at all to do that job, right? And now I'm going to be buying a title and escrow company or starting one. And then I want to create like a CPA firm. So all these pieces that are sort of connected to each other, they all will feed each other. And that's why I'm trying to grow that sort of like whole real estate ecosystem.
I love that. We've used the word on here, vertical integration in the past. And that is, for us, it's been property management or brokerage to property management to focusing on tax contesting. And there's so many different things. That's one of the most exciting things I always tell people that I love about real estate. There's so many different ways to make money. So vertical integration, that's awesome. It's crazy how often I've seen over the last 18 years, people like, man, I was awesome at flipping these houses, so I'm going to go buy a restaurant. Or I'm going to now become a day trader. It's like, man, those things are like nowhere close to like what you're working on. Like,
yeah, Michael Jordan was a great basketball player. I'm going to go play baseball.
Yes. So, right. So it's awesome what you're doing there. And that's such good words of encouragement to other people looking to kind of spread out their
well, I sort of have a passion for this exact thing now that I'm a business owner. So when I was working for other people, I was massively frustrated with not having opportunity to grow. I did not want a ceiling on me, and every job I would hit a ceiling and I would just work my butt off until I hit that ceiling. And then I got tired of banging my head into it, and I'd go find a new place and I would go. And that was sort of how my career went. It was always that like a stairway progression. I hit a ceiling, I move until I can't, and then I go to the next place. Well, now that I'm owning the business, I'm like, why can't I find another me? Why can't I find a person that wants to work their butt off and do really good, right? Like I'm looking at most employees that are waiting for someone else to give them a reason to try. It's very similar to if you were running a football team and you want to win championships and your bench players are like, hey, when you give me playing time, then I'll work hard. I'll practice when you put me in the game, or when you pay me, then I'll go produce results. But that's not the way the world works. What happens is the owner looks at the players that are performing and says, you're doing great, I'll give you a raise, or you're doing great, you'll get more playing time. So as I learn real estate itself, like we talked about today, I'm starting to be more passionate about talking to people how to apply the right mindset to what they're trying to accomplish. If you're thinking, I don't want to apprentice for somebody else, I don't want to build their business instead of my own, you're already in the wrong frame of mind. Like no one cares about teaching you anything, and they shouldn't. That's what you want. You got to bring value to that other person first. So what's unique about, to me, the real estate space is that there's not very many good people in it. Okay. Like there's certain things like owning a pizza restaurant. There's plenty of good pizza restaurants. It's probably hard to go compete with the pizza places that are already there. Not hard to be a good agent compared to all the other agents. Not hard to be a good investor. Most people will never go take action. Creating the mindset of I'm going to try my best and force the coach to put me in the game is, you're going to higher ROI on that than anything that we talked about today. I would just challenge people to ask themselves, are you playing the game like I'll give it my all when somebody else creates an opportunity for me? Because that's not anybody's job but your own.
That's awesome. I think we got maybe a trailer out of that one right there. So
yeah, there you go.
We were talking offline before we hit record. You have this awesome idea kind of for a mastermind, or it might be in progress already. Kind of give us some thoughts on what you're working on.
It basically was born out of what I just described right there. Was I would have people come to me and say, David, I want to learn how to invest in real estate, or David, I want to learn with this thing. And I would say, well, go to Bigger Pockets. Like it's free. You don't need to pay me to learn how to invest in real estate. Go learn there. And they would go and they'd come back and say, now what do I do? And I realized that the problems are just all like mindset and psychological. They don't have a support system around them. They don't have an encouragement system saying like, it's okay to go make mistakes. They have this knowledge, but they don't know how to apply it, type of a thing. So it's not me teaching people how to invest in real estate, just straight up. I don't have a mastermind that teaches people everything we talk about on the podcast that they can learn for free. I think that would be almost like predatorial to do. It's based on like success. This is what it takes to be successful at what you're doing. The mindset, the structure, the strategy, like the thing that I just described. So I bring speakers in that have been successful and we pick apart their brain to learn what they did. And then maybe they talk about how they built a successful legal firm, how a lot of them are like UFC fighters. This is how they got to the top of their division. This is what their process was like as they learned their sport. And the next phase of that is going to be us helping people achieve financial independence. So we're putting together a curriculum that is going to help people track what they spend their money on. That's their defense. How much money they make. That's their offense. And where they invest that money. And to me, that's like the triangle of success is you play good defense, then you play good offense, and then you invest the difference to make it grow. And I want to have people come in and training modules set up that teach people this is how you have self-control when it comes to running your budget. This is how you track, you inspect what you expect. And then this is how you can make more money next month than you made this month, right? What's stopping you? And then the last piece would be here's opportunities to invest. These are your different methods, short-term, middle-term, long-term, that type of thing. So I'm working on creating an ecosystem there for people that are listening to these podcasts, that are interested in what we talk about, that know, hey, I love what these guys are saying. I just don't know how to get there. It's not knowledge that they're missing, right? It's sort of that environment that they need to be a part of. And that's at davidgreenemastermind.com. That's where people can learn more about that.
Awesome.
We'll link to that in the show notes.
Thank you.
So, David, besides the mastermind, where are you going from here? You got a lot of things going. What does David Greene look like in 5 years?
That's a good question. So the mortgage company is a pretty big priority. So we're top 25 in California. I'm looking to take that to all 50 states. So the vision is you want to buy long distance or you want to do a BRRRR deal. You come to us, we get you pre-approved. We connect you to a realtor in the area that you want to buy that can help you. Eventually, there will be David Greene teams in the major metro markets that I've trained. That's just further down the road. It's really hard to build a real estate team. We send you there, you get the deal under contract, and then we either help you with the financing to buy it or we help you with the financing to buy it, and then we refinance it on the BRRRR for you. So growing that lending team is a really big piece of what I spend a lot of time working on now. I mentioned that I'm looking in California to have like all the things that create complication in a transaction under one roof. So you come to us and we can do your loan and we can get your agent and we can have our own title and escrow company so things don't go wrong and we can make it convenient for you. I'd like to have a solar company and a construction company so that when someone says, hey, I want to buy this house, what's it going to cost to fix it? We just send our person there and they give you a quote before you even buy the house saying, hey, here's what your rehab budget would be. And we have an appraiser on the team that says, hey, here's what I think the ARV would be. And we have a home inspector on the team that says, hey, like I did your inspection. We don't have to worry about, like, a lot of time people don't want to waive an inspection contingency because they don't think they have time. But if we have an in-house inspector, we can get it done the next day. You don't have to worry about before you even put your money in escrow. You can have an inspection that you're looking at. So all those little friction points that happen in a transaction, I'd like to eliminate them by bringing those people in house and holding them to my set of standards. And then the same would be for like a CPA. I'm looking for a talented CPA that wants to build a business that understands real estate law, real estate strategies to save people money, that we can take like, hey, if you buy a house with us, you're also going to get a CPA who can give you advice on the best way to structure this, or if you want to step up your investing, this is like how David does it, right? For all of our clients.
That's awesome. Again, we're going back to vertical integration. Hey, yep. So one last question before we wrap then. What about, most of our listeners are on BiggerPockets. Anything coming down the pipe in the next year or two, any little nuggets you can share with them that where the platform might be changing?
You know, I think, and I'm not authorized to talk about this, so I want to make sure I don't say anything I'm not supposed to say. I don't think it's a secret. BP is really trying to increase their podcast network. So it's probably going to look less like the David and Brandon show or the Brandon and David show. And they want a lot more podcasts for people to choose from. And we've seen that from the rookie shows come out, the money show, which is kind of like financial independence. The business show came out. Now they have Invest Her, which is like a woman's thing. I think they're going to have more and more podcasts that kind of niche to individual people that are looking for more specifics when it comes to what they're doing. And I think that in general, BP is trying to bring more personalities to their audience. They care a lot about bringing value. It's a tough position for them to be in. Like they're having people that first off, you have to trust because they could easily give bad advice that people could follow and lose money. And then these people don't work for Bigger Pockets, right? So a lot of them use that platform to build their brand and then just say like, sayonara, I'm going to go sell $100,000 course that I can make money at that BP stands against. So I think that they're trying very, very hard to continue providing value to their listeners while also protecting their listeners from people that might come out of that environment and kind of turn predatorial. So what I would expect is more books to be coming out, more podcasts to be coming out, more content and a wider range. I think you'll start to see them providing more information in the future regarding like financial independence, like playing defense, not just real estate investing on its own.
Got it. Hey man, we pitched the idea to them. You guys should spin off the local insights. Just what we're trying to do here in Chicago. Because everyone goes on, then it's like, all right, now I need the ground level stuff. You guys can do that in every metro. That's a huge. They're
starting that with agents that are advertising on the podcast, and only the people that live in that area will hear that ad.
Yep.
So
Chicago Jake Fugman in Chicago, who was one of our past guests here. Jake, we'll give you a shout out here because you've been very good to us.
There you go. And then the other piece I didn't mention is that there's a very good chance that the show Brandon and I do, we've already come out to 2 shows a week where we have the standard, we interview an investor, and then we added the mindset episode where we just find a successful person and kind of pick apart how they look at the world and share that. I think we might be adding in the one where I take questions directly from listeners and I answer that on the podcast for everybody to hear. So people can go to biggerpockets.com/David. They can submit a question, like a video of them asking a question, and then we'll make a podcast where I answer it. And I hope that evolves eventually into like callers, like Dave Ramsey style, calling in and asking their questions or on social media, and we can interact with them so everyone can kind of hear as we walk through advising or consulting someone on a specific deal. I think that'd be really fun.
Yeah.
All right. Awesome. This has been an awesome show. We'll move to our wrap up round, partially stolen from the Bigger Pockets wrap up round, but with a little different twist. All right, David, what has been your competitive advantage? You've accomplished so much. How have you been able to do it when other people would love to be in your shoes?
I understand geometric progression, and I talk about this a lot. It's like we call it like domino theory. So in the book, The One Thing, chapter 2, and this is my superpower. If other people start doing this, they will surpass me and kick me off of the throne that I'm on right now, right? You could become the next Daenerys Targaryen and just take over the world if you understand this concept. A 1-inch domino can knock over another domino that's 1.5 times bigger. The momentum that is created can make that happen. And if you follow that progression by the like 30-second domino or something, you're knocking over a domino the size of Mount Everest. And by the 50-something domino, you're knocking over the distance between here to the moon. Okay, it's massive. What most people do is they push over random dominoes that are not hitting another domino, so they're wasting this phenomena, or they continue pushing over the same size domino, and so they just keep scaling at the same pace. What I do is every time I have success in any area of life, which we'll talk about business right now, is I ask myself, like, what doors did this just open that I could use to knock over a domino that's on the other side of that door? So when I joined, I built my real estate investment portfolio, which got me into GoBundance, which is similar to like my mastermind, where I got around more people that were doing big things. And then I became friends with Hal Elrod, who wrote The Miracle Morning. Hal got me on the Bigger Pockets podcast because he knew Josh and Brandon. I did a really good job at the podcast, and then I asked, how can I write blogs? They put me in touch with the blog person. When I wrote blogs, I would ask Allison, what makes the best blog? Like, what would make you look really good in front of your boss? And she told me, and I actually hired people to help me write better so I could give her better content. Then when they said, hey, we want someone to write a book for Bigger Pockets other than Brandon, who do you have? Allison said, David. Then I had to write a really good book. That book won some awards from the National Association of Real Estate Editors. That opened up a door for me to get Forbes to pay attention to me, and I started writing for Forbes. That got me my second book deal. When I would get these books, I wanted Bigger Pockets to like me as their best author. So I'd go on a podcast tour talking about these books. Well, that got me good at talking. Being good at talking got me the job on the podcast with Brandon. When I got that job, I said, well, how do I do this as good as I can? That opened up doors. Eventually, I got more exposure. My real estate team grew. If you constantly look at like what your coach needs to make the team better, and you do well, it opens up opportunities for you. Like an athlete who gets good playing time, then they start, then they become a top producer, then they get endorsement deals, right? Like everything starts to open up as they progress. That's all that I did. I think I'm pretty much like an average Joe. I was a police officer that tried really hard to be a good cop that eventually turned into all this other stuff. Most people wait for the tap on the shoulder before they strive for excellence. They wait for someone else to give them permission to give their best or be their best. I would say start pushing over dominoes, see what falls. And when it does, see how you can get the next one to fall. Don't let the momentum stop. Right. And that requires a lot of personal growth, because oftentimes you realize that when the coach put me in the game, I wasn't fast enough. And I don't like how that felt to be not as athletic as the other guys. And instead of saying, well, how do I get faster? They just avoid the circumstances that cause them to have to face their own slowness. I was probably just a little bit more willing to adjust me to fit what the environment that I was in needed.
That's great, man. Yeah, success creates uncomfortable situations, and then how do you deal with those, right? New challenges to face. That's so good. So, David, what is one piece of advice you would tell someone that is yet to buy their first property?
Okay, I would say you're not going to stop feeling afraid. So quit waiting to not feel scared to take action. That's like saying, I don't want to go to the gym and lift weights until I'm strong. Okay. The weights won't feel as heavy when you're strong, but you don't get there without going to the gym. What they need to do is look at other people that are not as smart as them and say that person did it. So even though I'm afraid, I can still move forward. Now, you don't want to just blindly go by real estate, but there's a handful of fundamentals you got to get down. It should cash flow. It should make more than it costs. It should be in a good neighborhood, and you should keep a lot of money in reserves to weather a storm. If you just do those three things, you're 99.9% fine that you're going to do well in real estate. So that's the only knowledge you need to get started. The barrier is psychological. You're going to feel afraid. You don't know everything that's going to happen to you. And I think like that's the same as like the football game analogy that we're using. I don't know if I'm playing football, what the defense is going to do. When I'm on defense, I don't know what the offense is going to do. That can't be the reason I don't play the game. Right? You got to develop a comfortability with your ability to react to what they're doing and respond to it and learn from it, and know that you're going to get better through each iteration, every play that you see. Like if you're waiting to know everything about real estate before you buy the first deal, you're that person who's waiting to get strong before they go to the gym.
Awesome. Awesome analogy. What do you do for fun?
Outside of real estate?
Yeah.
Brandon Turner is a lot of fun to hang out with. So I go to Hawaii quite a bit to hang out with him. I started trail running, which it doesn't sound fun, but that's become a blast. I just got some really bad news about my back. I haven't come out publicly with it, but I think I ruptured a ligament like 8 years ago, and that's why my low back is hurting all the time. It's pretty clear that the ligament ripped off the spine. And so there's like, my low back is very unstable and causing me a lot of hurt. So I think I'm going to need surgery. So I'm a little bummed, like that stops me from working out more. But with most of my spare time, I spend like trying to keep up with physical health. So like weightlifting and exercising and stuff like that. And there's not a lot of like hobbies going on in my life right now. I get my fun out of the interactions I have with other people. I think in the future, I'll start a family and I'll have other things going on and there will be more fun involved. So right now, in order to not go crazy, I just have to force like the business stuff we're working on to be fun.
The little I know of Brandon, I imagine it's going to be tough to hang out with him though and not talk about real estate. Like I think that
you would think that, but Brandon has a brain. One of the things that I found out about him after the podcast, I just kind of thought Brandon was like a lovable dope. That when I listened to the show, I was like, oh, he's just a fun guy. He's massively smart. It just doesn't all come out on the podcast as much. So that dude doesn't just think about real estate. He's got so many crazy ideas flying around in his head. Like he's written 40 books in his mind that have never just been published. So yeah, awesome. You do talk about real estate, but you also talk about business and life and philosophy. Like he's a very, very talented guy.
That's awesome.
So besides anything that you and Brandon have written, what's a good book, podcast, or self-development activity you would recommend to our listeners?
There's a book called Pitch Anything by Oren Klaff.
Oh, that's an awesome book, man.
I'm glad you thought so. I never read it because I didn't like the title, to be completely candid. I'm like, that just sounds so
negative connotation.
Yeah. Right. But it was brilliant when I actually read it. He breaks down like basically communication styles and the way that the brain processes information to give you an advantage when you're trying to, instead of looking at sales, just look at being understood or getting people to see things from your perspective. I've read that book 4 times. I constantly use it to teach the agents on my team. It's a huge part of Sold and all the real estate series that I'm writing. It's that provided a framework. So I think that book is incredible. And the other one that I'm really passionate about is So Good They Can't Ignore You by Cal Newport. I think that is the antidote to the freaking entitled, egocentric, like toxic attitude that so many, I don't want to say millennials, but just overall Americans have, because it's been so easy, comparatively speaking, to get ahead in America compared to anywhere else in the world, that we just expect it. And we think that our job is supposed to provide a great living, a stress-free environment, purpose in our lives, fun. We have ridiculous, reasonable expectations of our job. And it's why most of us aren't doing as well as we could be at that job. And that book basically breaks down, you're here for this reason, get so good at doing that you can pick and choose your battles, right? Like, and that's, if you look at successful people, that's what they all did. Like Peyton Manning didn't say, well, I want to be good at kicking and I want to be good at blocking. Like, he just became the best quarterback that he could. And then he got to pick what team he wanted to play for. He got to run the entire offense. He got endorsement deals. Like, Peyton ended up having a really good life because he focused on providing value through that one thing. And I think if more people could sort of take that leap of faith and say, it's not all about me, I'm going to provide value for other people, they would find that opens up a lot of doors.
I'll have to read that one. So Good They Can't Ignore You. But sorry, I cut you off on that. Pitch Anything. I got excited when you said that. Like,
have you both read it, Tom? Have you read it?
I've not read that one.
It's an easy listen. Like, I don't know. I think it's read by the author. Like, it's a really easy listen on the audio side.
It was one of those books that I thought, how did I go my whole life without anyone ever telling me this? It was like a Rosetta Stone of communication, right? I all of a sudden just knew how to talk to people so that I could get them to see what I was trying to say.
Yep. All right. So besides yourself, name one person you'd recommend to real estate investors locally or on a national level.
He's not an investor himself, but he's still like a bad ASS, is Jocko Willink.
Oh, I love him too.
Listen to Jocko.
Extreme ownership gets brought up a lot here.
Yeah.
Read Extreme Ownership. You don't want to hear, the lazy side of you doesn't want to hear it. Okay. The part of you that is drawn to those late night infomercials with somebody on a yacht full of women in bathing suits is not going to like this, but the part of you that is going to find the best version of you is going to love it. So I just constantly tell everyone, I think what the world needs is more Jocko. I want his platform to get bigger. I want him to reach more people. I really hope he continues to grow, because that message that was really forged in the crucible of just hell that dude went through, being a SEAL, training SEALs, being asked to do things he wasn't thanked for, constantly having to improve himself if he wanted to succeed. It's like a gift that dude now has that he's sharing with the rest of us that didn't go through what he went through to get that information.
Yeah. We're huge Jocko fans over here. So, David, thank you so much. You provide a ton of value to our listeners. How can they learn more about you? And is there any way they can provide value to you?
I'm starting I have a YouTube channel that I'm looking to start to grow. So they can go to youtube.com/David Greene Real Estate. There's an E at the end of my name. If they want to know more about that mastermind, that's at David Greene Mastermind. And then, if they want to provide value to me, if they DM me or email me with somebody who wants to buy or sell a house or get a loan, I would love that. I mean, that's something I'm pretty passionate about, trying to grow those companies. So I would love that.
Good stuff. So, David, we end these episodes with a Chicago fact, and I'm a huge Bulls fan. Mark, not so much for basketball, but we've dropped a few analogies. We did a Jordan reference, so we're going to pivot there. I'll let you guys both answer. So, we know in the 90s, the Bulls won they had their 2 3-peats, 6 championships. Can you name, in the 6th championship, there's 5 different teams, 91, 92, 93, the 96, 97, 98. Who do they beat in the finals each year?
We're doing this together.
Let's see how far Mark takes it.
Detroit?
No, same conference. Come on.
Oh, no. Yeah. David.
I had to wait for a basketball guy to get on the podcast.
Utah, you got that one. That one's obvious.
Yep.
Phoenix side, I know that was another one.
Okay.
Yeah, Utah was twice, so that was the 5 and 6. Phoenix was 3.
Was Orlando one of them?
Nope.
No, that would be the East Coast.
Lakers?
Lakers were the first one.
First ones, yeah.
Both of these are out west.
Portland?
Portland, yep.
Yep.
And you're missing one. You're missing 96, the 72-10 team. Sean Kemp, Detlef Shrimp, Gary
Seattle.
Payton.
Yeah.
Oh,
Seattle
Seattle
Supersonics.
Yeah.
Yep. All right. Cool.
It was decent.
That's how good the Bulls were. You didn't even pay attention to who they were beating. It was just formality, right? Once they made it out of the Eastern Conference, they had already won.
David, you gave awesome information here today. I think the best thing I enjoyed most was you have awesome analogies. Like you had a couple of awesome ones that just made me chuckle. Like I loved it. So
well, thank you for that.
Appreciate that. I know our listeners are going to love this episode. Tom, thank you as always. Listeners, please, before you close out, leave us a 5-star review. Leave us a 5-star review right there on iTunes, or feel free to visit our website at straightupchicagoinvestor.com, where you can find all the resources, and you can find a link to all the local meetup groups that are mostly meeting in person now. So
Back, baby.
Yep, we're back. So Tom, David, thank you. Awesome show. And thank you, listeners, and we'll see you soon.
Thank you, guys.
See you next time, guys.